If you've just inherited a Roth IRA, before you touch the account, take a step back, because one wrong move early on can cost you years of tax-free growth you were never supposed to give up. The good news, if you handle this the right way, a Roth IRA is one of the most powerful assets you can inherit. Let's walk through how to do that. Hey there, I'm Andrew Rafal, founder of Bayntree Wealth Advisors, and let's break down how inherited Roth IRAs actually work and what to do with them. First, the landscape that we're working with here. If you've inherited a Roth IRA after 2019 and you're not a spouse, you're likely under what's called the 10-year rule. That means the entire account has to be distributed by December 31st of the 10th year after the year your parent passed. That's the hard deadline. Miss it, and the IRS can assess a penalty on what's left, so we don't want to miss it. Now, here's where most people get this wrong. With an inherited Roth IRA, you are generally not required to take anything out each year. No annual required minimum distributions. It doesn't matter how old your parent was. It doesn't matter if they had already started RMDs. Roth rules are different, and that difference creates opportunity. So what should you actually do with the account? In most cases, nothing for a while, because the real advantage of an inherited Roth IRA is tax-free growth. The longer the money stays inside the account, the more valuable it becomes. So let's put some numbers behind that. Say you inherit a $400,000 Roth IRA. If that grows at 7% over 10 years, the account could be worth roughly $787,000. And when you take it out or change the tax qualification, it's all tax-free. That's nearly $400,000 of growth that you kept. If you had taken that money out early and invested it in a taxable account, you would have given up a meaningful portion of that to taxes. There are three things to get right here. First, understand when the clock starts. The 10-year period begins the year after your parent passed, not the year of death. And that's an easy detail to miss. Second, make sure the account is titled correctly. It should remain an inherited Roth IRA in your name as the beneficiary. You don't roll it into your own Roth. That's a big mistake that can create unintended tax consequences. Third, be intentional about withdrawals. The entire strategy depends on letting the account compound. This isn't something you tap casually. It's there for long-term tax-free growth. So if you've inherited a Roth IRA, don't rush to withdraw from it. Make sure it's titled correctly, know the 10-year deadline, and give the account time to grow. Because handled correctly, this is one of the most tax-efficient assets you can have. And if this is the first time you're hearing about the 10-year rule, you're not alone. Most people don't know this until it's already right in front of them. And if you found this to be helpful, hit that like button so more people can find it. Subscribe for our weekly retirement planning insights, and we will see you in the next video. Happy planning, everyone.